Hey, and thank you for tuning in for the latest stock market news stories. For more videos on the top stock market developments, go press the like button and subscribe for more videos. With that being said, let's start our analysis. The market's exuberant rally in the first half of the year has encountered headwinds this summer, despite an increased number of companies surpassing earnings expectations. Notable giants like UPS, Apple, and PayPal managed to outperform Wall Street projections, only to witness a subsequent decline in their stock prices after their financial reports. This phenomenon has prompted investors to label it a snap back to reality moment, signaling a potential correction after a period of heightened market enthusiasm. In a telling example of the market's dynamics, CNBC executive editor Jay Yaro's recent experience with his Tesla has highlighted the emerging security risks associated with modern vehicles. Yaro's Tesla, which he had previously totaled, resurfaced in southern Ukraine under a new owner who gained access to Yaro's personal Spotify playlists. The incident underscores the evolving nature of cars into computers on wheels and the potential data security vulnerabilities that accompany this transformation. While Tesla instructed Yaro to disconnect his account from the vehicle, experts have pointed out that this does not necessarily prevent data extraction. The situation has led experts to emphasize the need for enhanced security features, such as a wipe all my info from this car function, particularly in the age of internet-connected vehicles. In a continued effort to stay competitive in the fast-growing electric vehicle market, Tesla has once again slashed prices on select vehicle models in China. The move comes amidst increasing speculation about the release of Tesla's revised Model 3, signaling the ongoing intensity of EV price competition. Additionally, renowned investor Cathie and her ARK Invest firm have made significant moves in relation to Tesla's stock, raising questions about the company's future trajectory. Tesla, the global EV giant, recently announced a substantial price reduction for two of its Model Y variants in China. The Model Y long-range and performance versions saw a reduction of $1,930, equating to a 4% decrease. This marks Tesla's third price cut for the Model Y in China, reflecting the brand's commitment to maintaining competitive pricing in a dynamic market. Notably, the base Model Y variant, which remains the most popular choice among Chinese consumers, saw no change in its price. This strategic price adjustment by Tesla is part of the company's ongoing efforts to expand its market share in China, a crucial battleground for EV manufacturers. By reducing prices and making EVs more accessible to a wider audience, Tesla aims to solidify its position as a dominant player in the Chinese EV sector. In a separate development, Cathie Wood's ARK Investment Management made headlines with its decision to sell over 100,000 shares of Tesla stock during the previous week. These sales were made as Tesla's stock experienced a period of retreat, prompting speculation about the motivations behind ARK Invest's actions. Over consecutive sessions, Wood's firm sold a total of 108,174 shares, with the sales amounting to $7.7 million on Friday and approximately $18.75 million on Thursday. This move by ARK Invest has ignited discussions among analysts and investors, raising questions about the firm's outlook on Tesla's future performance. As a well-respected figure in the investment community, Cathie Wood's actions often hold sway in shaping market sentiment. Shifting the focus from Tesla, another major player in the EV sector, Nikola Corporation, faced a challenging start to the trading week. The manufacturer, which has been grappling with a series of battery fires, announced a recall of around 209 of its trade trucks. The recall was prompted by investigations indicating a coolant leak as the likely cause of a fire at Nikola's Phoenix headquarters in June. While Nikola stated that its vehicles can continue operating, it advised customers and dealers to park the trucks outside until a fix is implemented in the coming weeks. This development led to a sharp decline in Nikola's stock value, which has plummeted by a staggering 98% from its peak in June 2020, when the company went public through a merger with a special-purpose acquisition company. Internal investigations by Nikola's safety and engineering teams have pinpointed a single supplier component within its battery packs as the likely source of coolant leaks, a conclusion corroborated by a recent minor thermal incident involving one of its engineering validation trucks in Arizona. In a positive turn of events for the EV industry, electric vehicle startup Canoo has secured incentive agreements with the state of Oklahoma and the Cherokee Nation. These agreements are estimated to be worth $113 million over a span of 10 years. Canoo has already commenced hiring for its vehicle assembly facility in Oklahoma City and the battery manufacturing factory in Pryor as part of these agreements. By entering into a partnership with the Department of Commerce, Canoo becomes eligible for performance-based payouts and various state tax credits and exemption programs. This strategic move aligns with Canoo's efforts to establish a strong manufacturing and production base, essential for competing in the evolving EV landscape. Despite these positive developments, analysts anticipate that Canoo may report a second quarter loss of approximately $75 million, based on Refinitiv data. Shifting gears from the EV sector, Amazon, the e-commerce and tech giant, has introduced a new generative AI feature aimed at enhancing the customer experience. This feature focuses on summarizing product reviews, providing shoppers with quick insights into what other customers have said about a product. The AI-generated summaries highlight common themes found in individual reviews, enabling shoppers to make informed purchasing decisions more efficiently. The rollout of this AI-generated review feature is part of Amazon's broader effort to integrate artificial intelligence into its product offerings. While other tech companies are vying for dominance in the generative AI space, Amazon's approach has centered on enabling developers to create their own AI tools using the company's cloud infrastructure, Amazon Web Services. Amazon CEO Andy Jassy has emphasized the significance of generative AI for the company's future, underscoring its commitment to leveraging AI technology across its various business units. In addition to the AI-generated review summaries, Amazon is also introducing a product insights feature that helps customers identify common themes across reviews. In other technology news, Apple is reportedly gearing up for a significant redesign of its Apple Watch X model, set to be unveiled next year. The tech giant is exploring the incorporation of magnetic watch band attachments to streamline the watch's chassis, contributing to a sleeker and more ergonomic design. Additionally, industry rumors suggest that the introduction of a micro-LED screen and a new blood pressure sensor could materialize as early as 2024, positioning the Apple Watch X as a frontrunner in health-focused wearables. You should also be aware that Morgan Stanley has reaffirmed its buy rating and $500 price target for NVIDIA, a leading player in the semiconductor industry. Despite ongoing supply constraints, the financial institution remains optimistic about NVIDIA's performance in the upcoming earnings report. Analysts at Morgan Stanley anticipate a significant beat and raise quarter, underpinned by strong visibility over the next few quarters. This endorsement highlights the company's resilience in navigating supply challenges and underscores its potential for sustained growth. Lastly, the landscape of U.S. commercial real estate is undergoing a significant shift in response to changing work patterns. With more than 70% of U.S. employers adopting hybrid work models and flexible arrangements becoming the norm, analysts are predicting a substantial 35% decline in office property values by 2025. The first signs of this impending crisis have already surfaced, as forced sales of commercial properties surged in the first quarter due to owners struggling to meet mortgage payments. Office loan delinquencies also reached 5%, indicating financial strain within the sector. The combined impact of reduced occupancy rates and higher interest payments has the potential to exacerbate the situation further. According to estimates by Morgan Stanley, approximately $1.5 trillion in commercial real estate debt is set to mature in the next 2 years. That is all the stock market news I have for today. So for more videos, remember to press the like button and subscribe. With that being said, happy investing.